Thanks for calling in, Abby. What do you make of this global bond market rally that is really taking on a more intense turn today?
It certainly has been very intense, and Sarah, it's very interesting to see which countries stepped up over the last 12 to 24 hours to lower their rates. New Zealand, Thailand, and India are all nations that are deeply affected by what's happening in this trade dispute. I was going to call it a skirmish. It's now bigger than that, between the United States and China. And we also need to look at some of the other countries that are significantly impacted by what's going on. And these include Korea and Taiwan, also Singapore, Australia, and let's not forget Japan. So we're looking at these interest rates moving lower. Art was very important in his historical observation about the Sumerians. We don't really know what happens with negative interest rates. There's the one way to look at it, which is the benefit we see in terms of equity valuation, but there's also a signal. And the signal from these very low interest rates is not just that inflation is low, but also there's concern about the pace of global economic activity. A good deal of this is, of course, related to trade disputes. We always talk about the bilateral situation between the United States and China. Well, let's not forget about Germany as well, the world's third largest economy, where there has been a sharp deceleration in economic activity since the end of 2017, and most of that is concentrated in the industrial, the manufacturing sectors in Germany, which really depend upon exports. So we are seeing a global impact on economic growth, so it's not surprising to see global interest rates moving lower as well.
Yeah, German industrial production, much worse today, down 1.5% month over month. Abby, what does all of this add up to in terms of the case for U.S. stocks?
Well, I think that David Kostin has done a fine job of laying out the base case, which is that what we are basing our analysis on right now is where we are on tariffs, plus the assumption that September 1, there's another 10% increase on tariffs from goods from China. And the forecast that comes from Jan Hatzius and from David Kostin's group basically say the U.S. economy continues to grow, albeit at a slower pace than the president often speaks about, and that earnings growth will continue. I think it's important to note, as David has pointed out, that while earnings growth for 2019, roughly 3%, we expect some acceleration in that, but the consensus expectation is much higher than ours. Currently, the consensus thinks that earnings can grow next year at 11%. We think that's too high, and so here's my point for investors, and that is we have now most of the results from this quarter's earnings reports, and not bad. More than 80% of the market cap has reported, and there have been some positive surprises for the quarter. However, in most cases, the guidance for the remainder of the year and for 2020 is not all that favorable, and I think that investors are beginning to look at that. So when we talk about the volatility in the market, a good deal of it is related to the fundamentals beginning to show some signs of slowness, and in some countries that slowness has been around for a while. And so there's one basket of concern. Some of those are the fundamentals. The other basket of concern obviously relates to policy decisions that are being made not just in the United States, but now in other countries.
So finally, Abby, let's say Jay Powell calls you up, wants to read on the markets and says, what do I do with all of this? In the global context, the rate move, the pressure from the president, what would you advise him?
I think that Jay Powell and his colleagues on the FOMC are in a very difficult spot. Jan Hatzius has concluded that we will likely see another couple of rate reductions. September looks pretty certain. He puts the probability at about 80% and another reduction later in the autumn. The concern, of course, is that interest rate reductions can only go so far in terms of their impact on the economy. If we were seeing a deceleration in economic growth in the United States because the cost of capital was too high, then of course those interest rate reductions would have a bigger impact. But what we're basically hearing from companies who have dramatically reduced their investment, CapEx and so on, it's not a function of cost of capital, it's a function of concern about uncertainty, about which way the global economy is going, where they should be putting their supply chains, and so on. And I know that Jay Powell and others in the FOMC are always looking at the intermediate to long term. That is, how do we bolster GDP growth long term? How do we bolster productivity long term? And there hasn't really been an opportunity to have much discussion in the markets about that. We're not seeing the sort of long-term CapEx, long-term R&D, and also the investment in people that we would need with regard to bolstering productivity.